Is it really that important to have a financial advisor in 2025? This might be a question that you've wondered yourself, and I'm going to explain everything in this video on whether or not you should have an advisor, what are the right questions to ask or interview advisors about, and also what are the different fee structures or pay structures that advisors may commonly get within Canada. So stay till the very end because I'm going to cover some really good knowledge on exactly what questions you should ask yourself and ask any potential advisors that you work with. So choosing a financial advisor is a very, very important decision. It requires careful consideration. It's kind of like choosing a life partner. With so much information available at our fingertips and so much knowledge readily available online, it's really, really important to make sure that you're not choosing someone that's biased and that's one-sided in their thinking, because there's a lot of rigid thinking individuals, especially in the financial industry. That's why we want to really take a big picture look to help you decide what is really the best thing for you. And although financial advisors are typically highly regulated, there's a lot of different types of advisors, a lot of different qualifications, and they all mean very different things. But at the end of the day, qualifications aren't the only thing that matters. Also, what matters is not just technical skills, but the big picture skill set that's really going to help you get from where you are to where you want to go. At the end of the day, that's really the only thing that matters. Now, do you really need a financial advisor in the first place? This is a very important question that I get asked all the time. Now, the answer is really dependent on person to person, but my best opinion that I can share with you is that it really depends on yourself. If you have a lot of different technical skills and you really thrive in managing your own money, you have not only the time, the knowledge, and the experience, but you're also interested and you want to be more in control of your finances, you may not need a financial advisor because not only can you manage the habits around money, but you can also be excited about doing it, which is going to keep you more consistent. Managing money is like having a habit that's consistently important to maintain. So if you are, let's say, trying to lose weight and you are going every, 2 months or 3 months, you're not going to get a great result if you're just doing a really, really good workout once every 2 or 3 months. But if you do it every day or every week, 3 or 4 times, even the small steps that can consistently move you forward is going to make all the difference. And it's the same thing when it comes to money. If you just check in on your money and your investments once every 3-4 months because you're too busy, even if you're very knowledgeable, having an advisor can be the right fit to help you make sure that you're staying on top of all those critical decisions during the times that you need to make them. When it comes to saving money, it can be very helpful to have a third-party person, whether it's an advisor or a trusted friend, to keep you accountable and staying on track to your budgeting goals and your savings goals. And also someone that can help you manage money and make the right choices and avoid making the wrong ones. So it's not always about helping you manage your investments and choosing the right stocks. So speaking of financial advisor, what qualifies someone as a financial advisor in Canada? There are many, many different titles when it comes to advisors. There's insurance and there's investment advisors. Now, every single type of licensing body has a little bit different scope where they can actually operate within. Now, an investment advisor, it ranges, but in Canada, the most common is going to be a mutual fund dealer. These individuals are licensed to be called a financial advisor. They're also licensed to sell mutual fund products exclusively through that license, which is a typically active managed type of fund portfolio, which does have a built-in fee. So that is how these types of advisors are actually getting paid. So all in all, a mutual fund representative is someone that is authorized to sell mutual funds and to also give advice related to what type of budget, what type of investments, how much, when, where, and what types of funds to use, and how to actually manage the whole big picture. And that is what a mutual fund dealer can actually do. But if you wanted to work with something where there's more options like ETFs, individual stocks, and you want to get a little bit more complex, a mutual fund dealer may not have all of the leverage and the options to work with all those different types of products and the entire scope that you're looking for. Now, an insurance advisor or insurance agent is someone that is licensed for life and health insurances within Canada. So that's typically what we call an LLQP license. And each province has their own regulatory body that governs and regulates agents that sell life and health insurance insurance products. Now, some of these life insurance agents may call themselves a financial advisor, but recently in Ontario, they actually legislated it where insurance advisors strictly are not authorized to call themselves a financial advisor unless they also have a mutual fund or other investment qualified license. But investment advisors can also sell segregated funds. So segregated funds are an insurance product, meaning insurance agents are able to give advice and help clients choose what segregated funds are suitable for them. So although an insurance agent is not typically a financial advisor, they can still give financial advice based on the different segregated funds or other insurance products that have investment components built in. So all in all, an insurance agent is still a financial guide, but they're just different from a mutual fund representative or other investment advisors. And finally, we have what's called the full service advisors, who are actually licensed to sell stocks, bonds, ETFs, derivatives, different types of specialty investment products, as well as other funds like mutual funds. And they're also able to give advice, and they're also able to give financial guidance when it comes to helping clients manage their portfolios. So it's a more of a full spectrum type of advisor that works with not just mutual funds, but other funds like ETF stocks. And typically they're going to be a fee-based advisor, which we're going to talk about in the next section. All in all, a financial advisor that focuses on retirement planning is typically a little bit different than one that focuses more on stock trading. A full service advisor may be more focused on stock trading, whereas a mutual fund dealer, for example, might be more focused on retirement planning. But they're both synonymous with one another, and either type of advisor can technically do both, except the mutual fund dealer is restricted to mutual fund products only, which is usually not going to be a short-term trading type of investment. It's going to be more for long-term growth, and it's not going to be as actively managed. Finally, advisors must also be authorized in each province where they're selling their funds and operating. And they also have to have liability insurance, which is what we call errors and omissions insurance, because the client is technically able to sue an advisor for giving them bad advice that could lead to any financial downfall. Now, you might be wondering, how are my investments actually protected? So it depends on where your money is held. For example, if your money is held through a bank and it's in a GIC or it's in a term deposit or one of those bank products, even a savings account, you're actually going to be protected through the CDIC, Canadian Deposit Insurance Corporation. And this is actually what regulates mostly bank products. It's up to $100,000 per account type per person. Okay, so if you have an RRSP with 100,000 in a GIC, your 100,000 would be protected if the bank were to default, which is pretty uncommon in Canada, but it's always good to have peace of mind. Now, with insurance products, that's going to be regulated through Assurus. Assurus is a nonprofit government organization that will actually protect you if your life insurance policy goes defunct because the insurance company went bankrupt. Now, there's really two different types of ways advisors can get paid. Number one, through fee-based advisors. Number two, through commission-based advisors. The pros of a fee-based advisor is that you're paying an upfront fee. So as soon as you actually have that first conversation, you're going to pay them, similar to a lawyer. And the benefit is that with a fee-based advisor, typically there's a less chance you'll get biased advice because they're not getting compensated directly for those products that they're offering. Thus, they're going to give you the exact information that they believe is the true information that you need. The downside, though, is that a fee-based advisor may not be incentivized to follow up with you and manage your money more over time. Now, commission-based advisors, they receive compensation from the products that they recommend. So a commission-based advisor, the benefit is that you're going to get more contact typically with someone that has incentive to touch base because they're getting paid on those products directly. But the downside of a commission-based advisor is that in some cases, these advisors may not be giving you the right information if you don't choose the right person. For me personally, I don't really care exactly how the person's getting paid. I care more so what they're actually offering and what is the recommendation that's being given. So there's great experts in both fee-based and commission-based advisors, but the really important thing is that you're choosing someone that you trust that's going to give you good advice, because there's good and bad apples on both sides of the spectrum. Now, in terms of experience, I would always recommend someone that has at least 5 years of industry-related experience, because the more experience, the more scenarios and the more ups and downs of the market and the more difficult situations that person has gone through, and also they've been able to learn from some of their past mistakes. Look, no one's perfect, and new advisors are going to make more mistakes than experienced advisors. Age also matters. If you're a young person and you want to have someone with you for the next 20, 30 years, don't pick an older advisor. That's probably not going to be your best pick. But if you're older and you think that maybe you need someone for the next 10 years, you might want to consider having someone a little bit more close to your age if that's more up your alley. Now, the first time that you're ever meeting with an advisor, the most important thing that you do is ask quality questions. For example, ask the advisor, how are you getting paid? Ask them, what is your track record of managing investments for other clients? And ask them, what is your target market and who do you typically like to help the most? Advisors that give you very bland or very sort of distorted answers, that's always going to be a red flag that that person might not be the most transparent. For anyone that asks me a question, I always give a direct, honest, and transparent answer because there's no point beating around the bush. Even if the client is not going to like what I have to say, it's important that I'm always honest and upfront with everyone. So always look for that level of honesty, transparency with anyone that you're working with, especially on that very first meeting. Also ask them what their service model looks like. So for example, how often are you going to be checking in with me? You don't necessarily need to look for someone that says, hey, I'm going to be looking at it every single day and I'm going to be all on top of it every single week. That might be a red flag that that person's overselling you on what they're going to actually do for you, because nobody works for free. If an advisor tells you that they're working for you for free, that's a sure sign that you should run the other way. Bottom line is, a lot of people just simply avoid financial planning because they don't have any information from school. They don't understand from maybe their parents not teaching them, and they just never took the time to actually learn this on their own. But with so much information, it can be very confusing for people that are new to investing. So it's always a good idea to sit down with an advisor, get some knowledge, ask them good questions, and see if this is going to be a fit for you. And I promise you, if you find the right person, it can tremendously help you along your journey to financial success. Happy investing, and I hope you enjoyed the video. We're going to do a series on investing in different types of accounts. If you haven't watched my TFSA or RSP video, please give those ones a watch. Give this video a thumbs up and subscribe if you like it, and leave a comment if there's any feedback that you have, and we'll see you in the next video.